Over the years as a financial planner, I've worked with many clients who have been granted company stock or just purchased investments on their own outside of their retirement accounts. And one question that seems to come up over and over again is, can capital gains push me into a higher tax bracket? So in this video, I'm going to walk you through how this actually works using the real tax brackets for 2025. And I'll share some examples using the latest updates to the tax code that we saw with the One Big Beautiful Bill Act to make it all crystal clear. So let's get started. So the first thing I want to cover so that we know exactly what we're looking at in the examples in a few minutes is the two different sort of tax systems that we have in the US. The first one is your federal income tax. So that's going to be your taxes on your employment income, so salaries, pensions, IRA withdrawals, Social Security, if it's taxable, rental income, business income, all that good stuff. So that income is taxed at ordinary income tax rates, which is this top chart here. So it's taxed at a marginal rate as well, meaning that each sort of portion of your income is taxed at a different rate here. So if you earn, say, $150,000 as a married couple, you would fall into the 22% tax bracket. But that doesn't mean you pay 22% on all of your income. That means you pay 10% on the first chunk here, 12% on the second chunk, and then 22% just on that last chunk that falls into this bracket. So the second tax code, or tax system, I should say, is long-term capital gains taxes. And as you can see at the bottom here, these are more favorable rates than your ordinary income. So this depends on your adjusted gross income or your total taxable income to determine what rate you pay. So a lot of people obviously are probably looking at the 0% rate here, which if you've seen my videos before, I'm very big on trying to stay within that tax bracket as a retiree if you have the right sort of investment mix. But basically this is saying if you're a married couple, you can have up to $96,700 of taxable income and pay $0 on capital gains, or long-term capital gains, I should say. You'll also see here that this applies to qualified dividends. We're not going to go into that too much in this video, but that's important to know that these are the same rates. Also, if you want to download this cheat sheet, there's a link in the description below with a ton of good numbers based on the current tax code for 2025. Just look for that link after this video. So the question that comes up a lot is, how do these two systems interact with each other? And if I go over this bracket by $1, does that mean all of my capital gains are taxed at 15%, or just the next dollar that's over that threshold? So that's what we're going to look at in the examples. Before we do that, I just want to look at another way of visualizing the way the two tax systems work together. So on this page, you have the married filing jointly tax brackets here. In the middle, it's going to be those ordinary income tax rates. And then in the green, it's going to be the long-term capital gains tax rates. And the same for single filers over on the right here. So basically, depending on your income, again, these lines are going to represent the top of the tax bracket. So 10% tax bracket applies up to income under $23,850. That would mean you're still in the 0% tax bracket for long-term capital gains. As you can see, the 12% tax bracket and the 0% tax bracket are not exactly the same. So they're about a couple $100 off, but basically this is a good way to visualize, what capital gains tax rate applies to you based on, again, your taxable income, which is this left column here. Now, what we'll look at in the examples in just a moment is that these two types of income are taxed separately. So although your income is both of them combined, it's then split out among these different tax brackets. So again, your salary would be taxed at these rates, and your ordinary income would be your long-term capital gains taxes would be taxed at these rates, depending on your total income. So it's important to note that that's how they kind of stack up against each other. And then you'll notice here, we're not going to talk about this too much in this video either, but there's also net investment income tax, which applies to capital gains or investment income over a certain threshold. So for married couples, it's an additional 3.8% for any investment income over $250K. And for single filers, it's over $200,000 is that threshold. So in our first example here, we're going to look at a married couple who are retired. We're going to assume that they're over the age of 65 and they have $70,000 of ordinary income. Let's just say that they retired halfway through the year and they had $70,000 in wages from their jobs. We're also going to look at how $50,000 of long-term capital gains affects their overall tax rate and whether or not that affects their ordinary income tax bracket as well. So in scenario one, we have their wages at $70,000 here, and then we have their long-term capital gains at $50,000, bringing their total income to $120,000. As far as their deductions, we're going to assume they take the standard deduction, which for a married couple over the age of 65 is a total of $34,700. Again, that's comprised of $31,500 for the standard deduction for a married couple. And then for each spouse over the age of 65, they get an extra $1,600 each. So in addition to the standard deduction, they will also get the senior bonus deduction, which is new under the One Big Beautiful Bill Act, and that's $6,000 per taxpayer over the age of 65. That does have a phase out limit depending on the adjusted gross income. So we'll look at that and how that affects their sort of withdrawals here in just a moment from their brokerage accounts. But after deductions, essentially that brings their taxable income to $73,300. And again, that is the number that we're going to look at to see what capital gains tax rate they fall into. So using that same chart that we looked at a moment ago, we can visualize how this different income is taxed and whether or not those capital gains do bump you up into a higher tax bracket. So once again, example one, we have the $70,000 in wages, $50,000 capital gains, $46,700 in deductions. It's important to note as well that your deductions are taken off of your ordinary income, not your capital gains. So that's actually beneficial because your capital gains are taxed at favorable rates. So you want the deductions to be taken off the less favorable income. But that basically brings down their ordinary income after taxes to $23,300, which means that they would fall into the 10% tax bracket, again, just for their ordinary income. Now, here's where the capital gains come in. So the $50,000 in capital gains are stacked on top of your ordinary income. So the floor of your capital gains actually starts where the ordinary income ends and then is added on top of that. So that brings their total taxable income to $73,300 when you add $50,000 to $23,300. And that means they are still within the 0% capital gains tax bracket. So they won't pay a single dollar in capital gains taxes on any of that $50,000. So going back to the main question of the video here, do long-term capital gains push me into a higher tax bracket? The answer to that is no. And once again, that's because your long-term capital gains are always going to stack on top of your ordinary income. So they have no way of pushing that ordinary income into a higher tax bracket. Now, that doesn't mean that the opposite can't be true. So in example 2 here, we're going to look at how your ordinary income can push your capital gains into a higher tax bracket. So going back to our tax software here, we have a second column for example number 2, where they still have $70,000 in wages from their employment earlier in the year. But in this example, we're also going to assume that they liquidated or withdrew $30,000 from their traditional IRA, which is going to count again towards ordinary income like we mentioned earlier. All the rest we're going to assume is the same. So still $50,000 in long-term capital gains that they realized from selling stock or other investments in a brokerage account outside of a retirement account. And then once again, we're going to assume that they still have the standard deduction, senior bonus deduction, but now that puts their taxable income at $103,300, which you'll remember pushes you into a different tax bracket for capital gains. So let's revisit that same chart to see what that looks like. So once again, to visualize this, we have our example number 2, this time with a $30,000 IRA withdrawal, but this time after deductions, their ordinary income is $53,300, which now puts them into the 12% tax bracket. So once again, they'll pay 12% on this amount. And then this also pushes up their $50,000 in capital gains into the 15% tax bracket. Now, to answer the other question that we asked earlier was, does this cause all of my capital gains to now be taxed at 15%? And the answer to that is also no. So fortunately, capital gains are also taxed at a marginal rate or a marginal system, just like ordinary income. So that means the majority of them in this scenario will be still taxed at 0%, but only $6,700 or so will be pushed into that 15% tax bracket rather than the full $50,000. So always important to note that. I've also gotten questions asking if my entire capital gain will be taxed at the next rate. But luckily the answer to that is no, just that next dollar. So the last scenario that I wanted to show here was the effective tax rate if this couple were to withdraw an extra $1,000 from that IRA. So you might think that IRAs are ordinary income. They're just going to be taxed at that 12% tax bracket like they were before. But that's actually not the case. So it's important to understand exactly the total tax effect for a withdrawal from an IRA. So as you can see in scenario 3 here, they take a $31,000 withdrawal. But what that does is, number one, they pay 12% taxes on the ordinary income. They're actually bumping another $1,000 into that 15% tax bracket, so that's 15%. And then they're starting to phase themselves out of the senior bonus deduction as well. So there's other things that your increasing adjusted gross income can affect that a lot of retirees aren't really aware of. So it's only $120 or so that they're starting to phase out, but as that income grows, less and less of that bonus deduction will be able to be used. So overall, that comes out to an effective tax rate of 30% just for taking out an extra $1,000 from their IRA. So with that, there are a few other considerations for retirees who may have these different sources of taxable income. So as we saw earlier, capital gains do count towards your total taxable income as well as your adjusted gross income, which is a figure that's used for a lot of different things from Social Security taxation to IRMA, which is your Medicare surcharges, and the senior bonus deduction that we just saw a minute ago. But your Social Security is taxed based on your provisional income, which includes your adjusted gross income plus half of your Social Security benefit, plus any non taxable interest like that of municipal bonds. And then your Medicare surcharges are also based on your modified adjusted gross income, which is your AGI plus any certain deductions that get added back. And then again, as we saw, the senior bonus deduction can start to phase out as your AGI increases. So these are a couple of other considerations to look at when you think about, taking an extra withdrawal from your IRA versus realizing those capital gains. So I know this is a complex topic. I really hope this video was helpful in breaking it down and making it easier to understand how different types of income are taxed. And ultimately, no, your capital gains cannot push your ordinary income into a higher tax bracket, but that doesn't mean that the opposite can't be true. As we mentioned earlier in the video, the financial planning cheat sheet that we referenced with the different tax brackets is available to download for free at one of the links in the description below. And finally, if you are watching this and you're thinking this is just all too much for you to handle and you want this to be done properly by a pro with your own retirement, feel free to schedule a free introductory call with us. We are accepting new clients at the moment, and you can do that at the link in the description below as well. If you did find this video helpful, please let me know by leaving a comment below and subscribing to the channel for any future videos. Thanks again, and we will see you in the next one.